good morning to you. We will be hearing from Jay Powell at 9 o'clock this morning. Are either of you expecting us to glean anything fascinating from that, Seema?
No, nothing. I think what we've been seeing in the last couple of days or so is all of these FM speakers, they're all speaking with one very clear voice. So if we're going to hear anything interesting, it's simply going to be Powell also pushing back on the idea that the labour market data is enough to stop them from taking rates further. And also, I'd expect him to also re-emphasize the fact that rate cuts this year are not on the agenda at this stage.
Emily, do you think he's going to be more aggressive, less aggressive? I mean, the market seems to think that he's going to slow down. And what I don't know is I think that part of his whole strategy is to make people think, at minimum, to make people think he's not going to slow down. So if he says anything that's even marginally aggressive, does the market sort of pull back?
Yeah, I mean, the mantra we continue to hear from Fed officials is that they're committed to fighting looser financial conditions. And by the way, they are losing that fight right now. Maybe not as badly as the Georgia Bulldogs won last night, but you look at financial assets and they are pricing in no probability really of a recession right now. You've seen this massive risk on rally. You're seeing the dollar getting absolutely pummeled here. Financial conditions are loosening. Financial assets are fighting the Fed, and they're winning. So,
Emily, just to follow on to that, if that's the case, what are you doing about it?
Yeah, I mean, right now it's tough to do, but we're looking at this as a late cycle bounce. It's remarkable to look at things like high yield bond spreads, close to 4%. That is not a recession signal. You look at U.S. sector outperformance, industrials, materials, energy, just incredible leadership out of areas very cyclical like European equities and Chinese equities, really on the back of the China reopening narrative and better weather in Europe. And those are not normal dynamics that we see in a late cycle period in an environment where the leading economic indicators have seen 5 consecutive readings of negative year-over-year growth. That is typically when you want to own higher quality, more defensive assets. And that's what we're doing in portfolios right now. There is not a lot to love on the equity side, given the fact that stocks are not particularly cheap at 17 times forward earnings. So we're looking for parts of the equity market that are already pricing in a recession. U.S. mid-cap value stocks are one for us, trading at low double-digit PE ratios. But I'll be honest with you, the income on high-quality bonds is looking pretty good to us right now, given this late cycle backdrop.
Late cycle, Seema, what do you think? Are you in the category that this is late cycle? And if that's true, what are you doing?
Yeah, no, I would echo a lot of what Victoria's just said. When we look at the economic data, you look at the yield curve, there is clear signal that recession is coming. And the fact that the market doesn't yet believe it probably means that this is a good time to be repositioning your portfolios. So taking down exposure to equities, agree, there's not much to love within the equity space. US mid-cap is probably the ones which is at least somewhat attractive valued in the US. And if you're really keen to go to be increasing exposure, I mean, look outside the US at this stage. The international markets are looking a lot stronger, partly because actually their economies are looking a lot stronger too. And then generally speaking, this is the time for fixed income, high quality bonds, investment grade, core fixed income. That's what's going to give you a bit of defense, but also for the first time in ages, it's actually offering a pretty attractive yield. And as always, this is an inflationary backdrop. It's coming down, but it's still an inflationary time. This is a time to also have exposure to real assets, so you get a bit of that inflation mitigation.
Seema and Emily, I want to thank you both. Appreciate it.